Good morning, everybody. It's Ed Yardeni. Thanks for joining us today. Eric is with me as well, and lots to talk about, certainly. First, let's start with the weather in Long Island. It's been unbelievably nice weather in Long Island, so we've been enjoying it a great deal. Coincident with the great weather has been a great stock market, though there's an issue here with breadth, clearly. If you look at where the bull market started back in October of 2022, the breadth isn't all that bad. It's just that some stocks are up a lot more than others, but there's plenty that are up at least 20%. But they've lagged behind some of the stellar winners that we've had so far in this bull market, mostly the Magnificent Seven or Mega Cap 8, as we tend to focus on, adding Netflix. But when you look at the market now, last week was kind of wild. We had the S&P 500 information technology sector up over 6%. It was the only sector that outperformed the S&P 500. Joe Abbott looked at it and said it's happened 4 times before since 1991. So it's an unusual occurrence. And it really speaks to just how narrow the market has become recently. But the question then that we addressed in a quick takes last night is whether we're already sort of into the melt-up phase and then the blow-off top phase in this stock market. And one of the things that's interesting is that the earnings situation is more supportive of this rally in tech stocks than it was in 1999 to 2000. Just last week, we saw that the market leaders included stocks like Adobe and other technology companies that have Oracle in mind. I guess also did quite well, and Broadcom. So meanwhile, Nvidia just keeps going up to new record highs, and it's done extremely well. So the market is very much focusing on the tech sector, very much focusing on the digital economy. Many years ago, we had the agricultural revolution, then we had the industrial revolution in the 1900s, and now I think we're in the early phases of a digital revolution. And the market looks ahead, and it's clearly pricing in that this digital revolution is going to be quite extraordinary, have tremendous impact not only on the companies that are very much involved in the digital revolution, but also might very well have a very positive impact on productivity. I think once that becomes clear, the market will broaden out again. Once it becomes clear that you don't have to make technology to be a technology company, all you have to do is either make it or use it. And if you don't use it, you're going to lose it. In other words, you're not going to be a competitor. And so I think there's going to be some good earnings surprises up ahead here in companies that aren't viewed necessarily as tech companies, but that will nonetheless benefit tremendously in terms of their revenues, in terms of their earnings and profit margins as a result of the technology revolution that we're very much in. Revolution's been going on for a while. It started out in the 1990s, but as we pointed out before, it was still pretty crude back then. You had these big Dell boxes sitting on everybody's desk, and you had Microsoft Office and Excel as the software that was most widely used with these big boxes. But then along came, I guess 2011 or so, along came the cloud. Along came more software that was very, very powerful, user-friendly, easier to update with the cloud. Instead of the business model for software changed from buying outright to renting. And when you rent software on the cloud, it automatically updates. So that was a huge productivity jump because you suddenly didn't need hundreds of people in an IT department to manage all those Dell boxes and update them office by office. It could all be done. It would all be done automatically through the cloud. So there's already been a productivity revolution, if you will, in technology itself with the cloud. We're like everybody else anticipating that artificial intelligence will have an impact. I think 60 Minutes last night on CBS had a show on artificial intelligence. We're still somewhat skeptical about how quickly it's going to have an impact on productivity. We think other technologies have already worked to increase productivity. Last year was a very strong productivity year. Um, Eric and I have been working for today for tomorrow's morning briefing on the idea that a lot of these hardliners who've been wrong about the recession for the past 2 years have now kind of changed their story. So now what they're saying is that, all right, there wasn't a recession the past 2 years, but now that inflation's coming down, if the Fed doesn't lower interest rates quickly and aggressively, then we're going to have a recession. And that commentary, that viewpoint was very prevalent at the beginning of the year. Recession didn't happen in 2022, 2023. Inflation started coming down. And so the hardliners said if there would have to be 6 to 7 rate cuts, and the market bought into it. The Fed kind of resisted it. The Fed talked about 2 to 3 rate cuts in their summary of economic projections. And yet the markets said, no, the Fed's going to have to lower interest rates a lot more. And I think that was the legacy of the hardlanders changing their story to a certain extent. Now I think what they're saying is because the Fed is now only talking about one rate cut this year and has confounded the market's expectations and certainly the hardliners' expectations that we need to have several rate cuts. The hardlanders are saying, okay, so we're going to have a recession after all. Some are actually saying we're in a recession right now. And Eric and I have been working on something we've dubbed TAMED, T-A-M-E-D, technical analysis of macroeconomic data. The idea being that a lot of economists are kind of looking at the history of indicators and coming up with rules of thumb, like the inverted yield curve has almost always predicted recessions with a few false positives. The leading economic indicators has had a very good record of telling us a recession's coming when it declines. We have the SOM rule, which Eric, what is the SOM rule? That's correct me if I'm wrong, but if the unemployment rate had been 4.1% instead of 4.0% in May, then the SOM rule would have triggered an all hands on deck emergency call red flag. Did I get that right?
Yeah, it's if the 3 month moving average of unemployment is 0.5 percentage point away from the previous low over the past year, and we're at 0.4 right now. So within a hair's trigger of it, I suppose.
Yeah, so the idea is what? That if the unemployment rate has gone up by a certain amount relative to its low, then history shows that that says we're in a recession.
Yeah, we're in a recession or one is coming, and I think the past predictability is anywhere from 3 months to like 2 years.
Yeah,
It's not the best in terms of market timing,
yeah.
which is kind of what we need.
Yeah, our approach has been to, acknowledge the fact that some of these indicators have had a pretty good track record, but not just to, embrace them wholeheartedly and, approach the economic forecasting as an exercise in technical analysis of macroeconomic data. Repeat that 10 times, Eric. Uh, but the idea is that you want to look a little bit more carefully. You don't want to just kind of like rest on your oars. You got to keep rowing. And so what we found is that when it comes to the unemployment rate, the recent increase, and actually I think year to date, a lot of the weakness in employment, and we're talking about the household survey where they call people up rather than the payroll survey where they get their data from a sample of companies' payrolls. But when they call people up, they found that there's been a lot of weakness in the 20 to 24 years old. Eric, do you recall offhand what the drop was in May?
I know it was the vast majority of May, and it's been like 800,000 plus year to date.
Year to date, yeah.
Yeah.
And there was like 403,000 just in May alone in the 20 to 24-year segment of the household employment. And it just dawned on us, wait a second, this is May. May, we all know there's a lot of graduations. maybe a lot of students gave up their jobs around their colleges, and then took a couple of weeks off before they transitioned into summer jobs. Now the data is seasonally adjusted, so if it's seasonally adjusted, why should that show up at all? And I don't have an answer to that. Eric, I was thinking that another possibility is that with Biden freeing up a lot of students from their student loans, maybe some of them have figured out, hey, I had this job in college. I can really just have a blast during the summer since I don't really have to worry about my student loan. So I don't think there's any way empirically we can prove that, but that's I didn't share that idea with you yet, Eric. So we're doing it here in public. So let me know what your thoughts are on that along the way. Um, anyways, uh, Eric and I have also been obviously paying close attention to the inflation rate. And again, the hardlanders acknowledge that inflation turned out to be more transitory than they had thought and less persistent. And so as inflation came down, their argument now is that the Fed doesn't lower interest rates quickly here. The real rate's going to go up, and that's going to depress the economy. And even without that argument, just the whole idea that interest rates have gone from 0 to 5.25%. You hear a lot of these diehard hardlanders saying, "Well, surely we can't just have that." I think actually I heard Rick Santelli on CNBC make this point. There's just no way that we can have interest rates go up that way without suffering some pain and without having a financial crisis, a credit crunch, and a recession. Well, the inverted yield curve was right. We did get a financial crisis last year. Didn't last very long, but so far, because the Fed came in and intervened with a liquidity facility last year, well, we have not had a credit crunch. We have not had a recession. Let's have a look at the charts that are related to inflation. So let me share the screen with you here. Here it is. Okay, so today's June 17th. It's Monday, and we're looking at the morning briefing where we focused on the Phillips curve. That's sort of another tried and true model that's hasn't been particularly useful and has been somewhat misleading. The idea that there's an inverse correlation between inflation and unemployment. And I think, again, that's one of the reasons Hardlander said we had to have a recession, is because history shows that the only way to bring inflation down is with a hard landing, is with a recession. And if you look at figure 1, which has the CPI going back to 1914, you can actually see that, inflation tends to peak before recessions. But what we observed is that it's actually since the 1960s that you see that inflation peaked during recessions, and suggesting that it took a recession to bring inflation down. That was the case here, 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 here. I mean, just about every incidence here when inflation came down, it was associated with a recession. You look at the period prior to the 60s, and the correlation is nowhere near as tight. You typically see inflation actually coming down before recessions hit in many of these instances. So it's history matters, and maybe it doesn't really matter what happened prior to the 60s. All that matters is that it's been working pretty consistently. So if you have a spike in inflation, as we do here, you have to have a recession to bring it down. And yet that hasn't been the case this time around. We've seen that inflation has come down quite sharply. And take out shelter, it's already down to 2%. Shelter inflation is moderating. Eric and I showed that the 3-month inflation rate in shelter is moderating faster than the 12-month rate, which suggests that we've got lower to go on the year-over-year percent change. And this is what this is, year-over-year percent change. This is one depiction of the Phillips curve. It shows the unemployment rate versus the CPI inflation rate. And there clearly is an inverse relationship in these two variables. So there, since the 50s anyways, it does look as though a increase in the unemployment rate is a precondition for bringing inflation down. Though again, we're in an environment now where the unemployment rate's been at 4% or less for 30 months in a row. And even though we've got a very tight labor market, you can see that the inflation rate has come down all by itself pretty dramatically. And as we've said, part of that is because goods inflation is turned back into deflation, simply because we'd still import a lot from China, and China's prices are falling. But I think it's broader than that. I think durable goods traditionally, well, for the past several years, have tended to deflate. Maybe that has something to do with the commoditization of these products, and that's helped to bring inflation down. But let's continue here in this look-see. So we've got the official headline unemployment rate versus wages this time, and again, there seems to be a fairly relevant inverse correlation, with an exception again, where wage inflation has come down pretty dramatically here. So maybe there's something post-pandemic. Maybe there's something that's evolved over time, where the economy is more competitive domestically and internationally. There's more technology, more productivity, and that we don't really need to have the unemployment rate go up in order for inflation to come down. And that certainly has been the case so far. And by the way, Fed Chair Jerome Powell has been sympathetic to this idea for a while in his press conferences over the past few years, arguing that there might be a narrow path by which the economy might be able to have inflation come down without an increase in unemployment. He made that sound like a low probability scenario. Made it sound like he was hoping for it, but wasn't promising it. On the other hand, he did indicate that it could require some pain with some increase in the unemployment rate. And the summary of economic projections at the Fed typically hinted that they did anticipate to see that unemployment would have to go up in order to bring inflation down. But again, that just hasn't happened so far. Maybe the SOM rule is about to kick in at 4.1%. And again, I'm amazed by how many people are convinced that we're back on the cusp of a recession. But here's another slice and dice of headline unemployment versus this time a different measure of wage inflation, a more comprehensive one, but a much more volatile one, which is hourly compensation. So that suggests that the correlation isn't quite as tight when you look at the broadest measure of compensation. Then we have many times pointed out that unit labor costs is really the inflation rate that we think is the key here for understanding the underlying inflation rate. As you can see here, unit labor costs, which is hourly compensation divided by productivity, is down sharply. It's down to 0.9%. And it's fairly highly correlated, at least in an underlying sense, with the CPI headline inflation rate. We're not even taking out food and energy. We could take out food and energy, and the correlation is still extremely strong. So what this brings into the equation is that the Phillips curve might be missing a variable, and that is an understanding of productivity. It's not that you have this shows that you have a direct correlation between the inflation rate as measured by the CPI and the inflation rate of unit labor costs. So it's a direct correlation with hourly compensation divided by productivity. So productivity matters a great deal in this view. I was going to call it a model, but I think it's really a causal. It's a correlation model that one can argue if there's a causality involved here. And this is another interesting chart bringing in productivity into the story. You can see that this is the 20% change at an annual rate in productivity. We've looked at this variable many times. We've noted that it's dropped down to 0.5% in late 2015, that it's up to 1.8%, which is a pretty healthy increase. And we've been arguing that it could go to 2.5%, 3%, maybe 3%, maybe 4%, which would all be amazing for the economy because that would go straight into real GDP. It would go into reducing unit labor costs and keeping inflation down. So it truly would be an extraordinarily robust, solid economy with low inflation. Obviously very bullish for the stock market if that's the case. And that's a roaring 2020 scenario that Eric and I have been talking about. But again, you can see that what's interesting about this chart is, let's not forget that if the labor markets are tight, companies may actually have an incentive to increase productivity. They don't necessarily have to just raise prices or just be forced to raise wages. They may also decide that the only way that this is really going to be a profitable environment for them is if they increase their productivity to offset the increase in hourly compensation, for example. And that's, I think, what we're seeing here. A very tight labor market is associated with productivity increasing. And we think this is another productivity cycle like some of the ones we've had in the past that did peak between 3 and 4%. So there's no particular reason why this one couldn't do the same over the rest of the decade. Here's just another slice and dice of productivity, and just pointing out that this is all just forecast and hypotheses that we actually had a very strong productivity number last year on a year-over-year basis of 2.9%. Quarter to quarter tends to be pretty volatile, but when you look at year over year, you get a better picture of what at least the short-term picture looks like, whereas this gives you the 20-quarter kind of big cycle view. With regards to inflation, before Eric joined us, we were looking at inflation back in 2022. And back then, we argued that it might peak around 6%. Then Russia invaded Ukraine. We said, well, maybe more like 7%. And so we established this kind of range for where we thought inflation would be in the first half of last year, of 2022. And then in second half of 2022, we felt that it could get down to this kind of range to 5 to 4%. And you can see that we didn't quite get that right. And then last year, we started to talk about 3 to 4%. And by the end of last year, we're talking about 2 to 3%. So these have been our forecasts, and we haven't had to change them. So they're working out pretty well for us. And we still think we're on track to get down to 2% by the end of this year. The Fed folks are talking about getting there by 2026, but they're talking about getting pretty close to 2% by 2025. So here's goods inflation, durables and non-durables, and you can see that the non-durable goods inflation is quite low. The price of oil's come down, food inflation has come down, and then you can also see that the durable goods inflation rate is down 2.2%, and that's through April using the PCED. I want to show you what this looks like in a second on the CPI, but again, with the PCED, you can see that the services inflation rate has been the more persistent inflation, not the goods inflation. And but on the other hand, the rent is coming down, and the overall services inflation rate is continuing to come down, as we think it will continue to do so through the end of the year. Contributing to this is to the goods disinflation is that we've got deflation in China. So this is U.S. import price index for Chinese goods, and that is the blue number here. And you can see that we're down 2%, and that's been a very powerful deflationary force on the U.S. core CPI goods, which is the red line, and the U.S. core PPI goods has been fairly stable around 2%. Here's a really interesting chart. While everybody keeps focusing on services and saying, well, goods inflation is down, it's not. It's probably down about as much as it can go. Figure 12 shows you the durable goods inflation rate all the way back to the 1940s, and you can see that when you take the year over year, and this is the CPI now, not PCED. So we have the CPI through May, and that was down 3.8%. I mean, we still have a lot of deflation in durable goods. Meanwhile, as we said, rent inflation, Eric's done some work on this. You can see that the 3-month change in rent inflation of primary residence and owner's equivalent is below the year over year, which suggests that the year over year is going to continue to decline, which is what we think. Then the services, other than rent, the big problem we still have is in transportation services. You can see that's still quite high. We've had some pickup here in medical care services. Some of that has to do with healthcare insurance in the CPI, which is a very cockamamie variable, as we'll show you in a minute. So let's look at the transportation services. This is motor vehicle insurance. It's been insane, right? In the CPI, it's up 20.3%. In the PCED, it's up 7.4%. Go figure. Well, Eric looked into it, and it turned out that the PCED accounts for when you get paid on your claims. So I guess this is gross, and this is net motor vehicle insurance. And most of us are experiencing gross, which has been really gross, with an increase of 20% just in the past year alone. I think it's up 40% since the start of the pandemic, maybe a little bit more than that. But keep in mind, the PCED does have several variables that tend to be a little less inflation prone than the CPI. And that's important, of course. This is auto repair and maintenance. That soared. Now it's moderating, but it's still extremely high. And we think that part of this has to do with the fact that people are voluntarily buying bigger monster SUVs and trucks, and that these cost more to maintain, more to repair, more to insure. So we kind of question whether that's purely an inflation phenomenon or whether it has something to do with the standard of living. People are feeling pretty good buying these trucks. You wouldn't know that from consumer sentiment, but we are seeing car sales holding up around 15 to 16 million units at an annual rate. And 80% of those are light trucks, so-called, which are these F-150 Ford cars and other big monster trucks. Home insurance is another service inflation rate that looks like it's peaking. That would be nice if that was the case. I think some of this has to do with people living on the coast of Florida or in the middle of forests in California, and people have just moved into areas that just aren't all that safe environmentally. And maybe it has something to do with climate change. Maybe it just has to do with the fact that people like to live in nice areas overlooking the ocean or in a dense forest, not recognizing that all it takes is one hurricane to wipe you out or one terrible fire to really cause a calamity. This is this crazy home health insurance variable. Pay no attention to it. It makes no sense whatsoever. Let's pay more attention to the PCED inflation rate for health insurance, and that just hasn't been an issue. But it's still negative on a year-over-year basis, and now maybe we're going to have some problems here with this thing swinging to the upside. I used to recall why this is so cockamamie, but it was so cockamamie that I forgot the explanation, and we're running out of time, so I won't ask Eric to jump in. Meanwhile, consumers are telling us they're not happy. We see that in the Consumer Sentiment Index. Eric and I said, well, economists look at inflation on a year-over-year basis. Maybe real people look at inflation on a 4-year percent change basis. They remember how much inflation has increased since the pandemic, and they can see that there's these huge double-digit increases, and that things are essential. And why is veterinary and pet services essential? Well, Max and his brothers and sisters, they're close family now, and whatever they need, they get. Fortunately, we have pet insurance. If you haven't gotten pet insurance, you can still get it because you can see what the vets and pet services are costing these days. We did look, as I said, at the household employment data, and this is just the May numbers, and you can see that 20 to 24 years old, they dropped 474,000, and they just happen to be college students. So maybe there's something just wacky going on here that explains why the unemployment rate went up as employment among college students dropped like that. I just put it into context, as Eric mentioned, we looked at the year-to-date change, and that's 811. So half of the drop in employment by college students has occurred in May. But again, since the beginning of the year, it's down 811,000. And why is that? Maybe, again, it has something to do with Biden forgiving the student loans and students saying, okay, so I don't have to work to pay off my loans. Okay, let's, Eric, let's look at the Q&A here. Eric, you want to read them to us and then decide whether you want to field it? So start out with Saud.
Yeah, so we have the applications of AI might seem to take time, and that's maybe due to scaling of applications. There's hurdles to clear, one of them being power. So what are our thoughts on utilities?
You want to field that, or you want me to jump in? You tell me.
Yeah, I mean, I think utilities have done pretty well. The data center demand, you listen to earnings calls and they're all just talking about data centers and power. So that was one of the AI plays that many people didn't notice, but I think, they're already starting to benefit. So they should continue to benefit, but the market's clearly taken notice.
Yeah, I think the again, it could be one of these things that makes a lot of sense, but it could take some time because they are presumably going to have to spend some big bucks on improving their capacity, and before they get just a deluge of revenues from selling electricity, which by the way is regulated, so it takes a while to really pass your costs through. They may get squeezed a bit, but we saw copper take off as a AI play. Just read an article that Argentina is planning on really pursuing. Apparently, they've got a lot of copper, and so that the new president there is kind of views copper as the new oil. So some of these notions that copper is an AI play and utilities are an AI play. Yeah, I think Nvidia is the clear AI play. It's the only player that is certainly seeing their revenues absolutely explode to the upside, and everybody else. And the reason for that is everybody else has to spend money on these expensive GPUs. So again, the question is, when does the revenue and earnings benefit show up relative to how much it costs to implement these things? Go ahead with Ian.
Yeah, so Ian asks, what are our thoughts on the non-reporting or kind of sketchy self-reporting for the employment numbers, especially post 2019 when people started businesses and those could be failing due to either lack of loans or inaccessibility of capital and the normalizing of the economy?
Yeah, Eric, you've looked at business applications, and we've thought about this somewhat. You want to feel that?
Yeah, so this also plays into the whole birth death model, which is a funky thing that some people argue is why the payrolls numbers have been so strong. And they have actually added about half of the payrolls numbers are due to this birth death adjustment for business closures versus business openings. But no, I mean, we've seen business formation applications, which are tracked through a different series, have really risen a lot over the past couple years. So maybe people have more time with work from home to start new businesses, or, they have a lot of wealth to tap to do this. But I think that, it's definitely a little bit more of an entrepreneurial vibe going on right now.
Yeah, let me just finish off. We got three more here. Brian asks about our an update, a review, a reminder of our economic projections. So again, three scenarios basically: the Roaring '20s, 60%, the 1990s melt up 20%, and 20% for a repeat of the 1970s. In the interest of time, let's move on to Gary. What does history tell us about Mr. Market 3 to 4 months prior to election and after election? Would corrections of 10% in the indexes surprise you prior to election? No, I mean, we wouldn't be surprised by a 10% correction. This election promises to be perhaps the wackiest of them all. Let's see if Biden can make it all the way to the election. He hasn't looked. Looks like he's been deteriorating pretty quickly here, but I'm not quite sure that Trump is holding up all that well either. So we'll see how that goes. They both should retire and just take walks together and annoy each other and leave us be. But thanks for that question, Gary. And we'll have another look at it, Eric. Put it in our to-do list. We do have some charts on that, and we'll update them. Finally, Gus, Ed, do you have tougher compares? You have tougher compares for year-over-year inflation. How does that come into your analysis? Where can this delay the decline in inflation? Eric, I don't get this base effect idea. I mean, okay, so inflation's come down quite a bit. Why is that going to suddenly cause inflation to go up? I mean, if inflation is inflation, prices are prices.
Yeah.
I don't. Do you have any idea why this? I guess Powell kind of mentioned it in his presser, right?
Yeah, so I think this is why the Fed actually raised their forecast for the PCED through the rest of the year to kind of hedge against these base effects. Basically, what it is if the PCED rises more than like 0.2% each month, you're going to be taking out lower compares from the previous month, the last year, and then therefore you get a big rise in year-over-year inflation despite month to month it's just kind of coasting in the same way. So I don't think, I still think we we see inflation printing lower than that on a month-to-month basis, it just kind of gives you less like wiggle room.
Okay. Fair enough. Yeah, the bottom line is we're still looking for 2% on the inflation rate by the end of the year. Eric, thanks for joining me. Thanks to all you folks that joined us as well. By the way, I hope you all had a great weekend and a great Father's Day. And let's do this again next week. I may be on vacation, so Eric might be in charge, but we'll keep you posted on that. Thank you.
Thanks, everyone.